My name is Boafi, and I bought my first investment property when I was 19 years old, and it settled just after my 20th birthday. And for the first asset that I purchased, it was something that I'd wanted to do for around 18 months to 2 years before. I'd become quite impatient, and I had a light bulb moment when I was probably around 17 years old, when I would watch a lot of adults in my life and people. I was very observant, and I would see people would be working jobs for the same company for 10, 20, 30 plus years. And I remember seeing people and realizing that after this long period of time, they wouldn't have much to show for it. I also recall being in high school and university was always really quite fun times, and I wanted to get it to that point again as quick as possible. And I always knew that at 20 years old, something was fun and my expectations of a good life was a certain level, but I always knew that at 30, 40 years old, that I would want very different things. And if I didn't prepare, I'd have a very miserable life at 30, 40, and 50. It would be on a descent. And I wanted to keep my life going on an ascent. So for me, it was very obvious that most people were in big financial trouble. So I knew I had to do something. So at 19 years old, I had bought a property and decided that I needed to take some serious action. So first of all, the big light bulb for me was I bought this asset while I was working in hospitality. I was actually a kitchen hand. I would work there nights while I was finishing university. So every single year I was able to save up around $15,000. And that was working for around 4 or 5 nights a week. So, putting those hours in. So when I bought that house at 20 years old, it was $135,000. At the time, I was extremely scared, but I was more scared of not doing something. The alternative was scarier to me, and that's why I took action. So the asset that I bought for $135,000, I had 3 major costs associated. I had my stamp duty, which at the time I believe was around $7,500. I had my lender's mortgage insurance, which at the time would be close to around $5,000, and I had my deposit. And at the time, I put around $13,500, which was a 10% deposit. So all up, I was all in for roughly around $25,000 approx. And it took me to get to that point roughly around 18 months. So 18 months of working 4 to 5 days a week. I would work from 5 p.m. to around 10:30 most nights during the week. The big light bulb moment for me came when my asset that I purchased for $135,000, I had that revalued after 24 months, and the asset came back at $194,000. I realized that from that growth from 135 to 194 in 24 months, so that means that I had made around $59,000 in profit. So the $59,000 that I made in gross profit or equity, if I was to equate that to my working life and what I was earning, that would be roughly 4 years of work. So I now had this house, this worker bee house, that was earning me much more than I was earning from work, and I hadn't had to do much to actually get that. So that means if I was to sell the property, my gross profit would be $59,000 before taxes. Now, I remember when I was purchasing property in Ballarat, for me, the numbers made complete sense. However, there was 3 main things that people were telling me when I was buying. First of all, they were saying that the property that I bought originally for $135,000 was, was a ripoff. It was risky. So, I had uncles and people that, I didn't want to be like, telling me that, I was making a wrong decision and it was a risky thing to do. So there was a lot of naysayers. There was quite a bit of negativity for people that were hearing, why do you want to buy a property? Why don't you just be like us? Why don't you be normal, buy a car? And I felt in my friendship group, I was started to be unincluded in things, and I was a bit of a black sheep. So people were saying, the broader population was saying, things are risky. The other thing they were saying was it's too expensive and it's not worth it. So they were saying that the expenses on the property were too high, it was too far away, and it wasn't worth $135,000. For me, it was like, it's 90 minutes away from CBD. You know, I bought what I could afford and felt like the fundamentals of the investment made sense. So I didn't listen to those naysayers. And the third thing was people were saying that it was either bad timing, or they were saying like, what if it crashes, or if the market was to drop even further. Again, I thought that was pretty irrelevant, and I wasn't going to take advice from somebody that I didn't want to be like. However, here's what I learned. There's a lot of people that are waiting for the right time to invest, and then they end up not taking action, and then the market starts to move and they miss their opportunity window. So it's important to often at times do the opposite to what people are saying, to what the media is saying, and never listen to people that aren't in a situation that you want to be in. Pick your mentors and pick your advice wisely on who you're going to follow. For me, thankfully, I didn't listen to those people that were telling me that it was risky, too expensive, and it was bad timing. I chose to just be fully focused. And the other thing for me was the alternative was quite bad. I was happy to take a risk and fail, but I was not prepared to not take a risk and then end up in a situation that I saw that 90 to 95% of people were getting stuck in, which was working a job in a repetitive cycle and essentially working 30 or 40 years and not really having anything to show for it. That was just not an option, and that was far scarier than me making a mistake on an investment. And that's what caused me to take action. You're only going to take action if the fear of not taking action is greater than the fear of then perhaps making a mistake. Now, when I bought this asset, first of all, I bought what I could afford at the time. Now, it's not something that I would say you should always do, because you shouldn't just buy a property because you could afford it. But at the same time, a lot of people get analysis paralysis and then end up not taking any action. So I bought what was affordable. The other thing was I actually managed the risk. So people said it was risky. I managed the risk. How did I manage the risk? Well, I wrote a list of around 15 things that could go wrong. And then rather than getting overwhelmed with those 15 things, I actually figured out a way to minimize all of those things. So these were things like, what if I couldn't get a tenant? What if the rentals dropped? What if the tenant trashed the property? And there was answers for each one of these risks. Things such as insurances, things such as getting multiple rental appraisals before I bought. I tried to buy at a really good price point that would have enough cash flow buffer in if I had to drop the rental income. Well, then I could afford to hold the property, even working as a kitchen hand. So I addressed the risks, I handled the risks, and then that gave me the confidence to take action. So things are only risky if you don't have the knowledge and if you don't acknowledge the risks. And I encourage anybody who's quite scared, make a list of those things and then discuss how you're going to handle each one of those risks. Now, the other thing that I realized is I was putting a 10% deposit down. The bank was putting down a 90% funding on the property. So the bank was at more risk than I was at risk. And if the bank is valuing the property, reviewing the rental income, they check the area, they're taking a majority of that risk. So the bank's betting on me, the bank's putting a bunch of buffers in place, and the bank's still telling me, hey, we think this asset is going to be something that's safe and decent. So to me, that was a no-brainer, and that's what also helped me get over the line with taking the action. So when it came time to duplicate, what I did was I took some equity out, but I used a lot of savings, and that's what helped me a lot, because you got to remember, if you're always just relying on taking equity out, you're going to lose borrowing capacity quite substantially. And if you lose your borrowing capacity, you're not going to be able to keep lending. You're not going to be able to keep having these worker bee properties that are making you money. So it's always good to keep being assertive with your savings, keep being diligent, have a savings plan, use a budget. So what I did to get to property number 2 and 3, it was a combination of equity as well as savings that I'd made over the subsequent 24 months. Now, what I did is I got a deal on the next 2 purchases that were probably slightly lower quality than my first purchase, but they were in the same area and they're actually in the same street. Now, the next property purchase was around 170 and the next one I believe was around 175. So as you can see, if you were to work out the funds to complete again, 3 main costs. You're going to have your stamp duty, lender's mortgage insurance, and LMI, which will give you all in for each property roughly at around 26 and 26 and a half at the time, something like that level. And that would be based on around a 10% deposit. Now, to get to this, again, I had started increasing my income at that point. So I was working around 3.5 days a week for a property management firm. So it was like a permanent part-time role. And I was probably grossing around $48,000 a year. But I also was doing some like odd jobs on the side and like building it up through some consistent casual work that was able to get added to my borrowing capacity. So I was probably sitting around the 65,000. What helped me duplicate actually was, first of all, I didn't rely only on the equity to rip money out. I had consistent casual income and permanent part-time. And also these properties were really cash flow positive as well at the time, which was also great. Interest rates were a little bit lower and these properties had really strong cash flows. So both of these properties had at least around $185 to $200 a week at the time, which significantly assisted in the duplication of the property stuff. So if you were to figure out how much I'd saved, I think I had roughly around 25K, which nearly funded one of the assets. And then the duplication came from a little bit of equity pulled down on the first property. So I was sitting there, I was around 21 and a half, something like that. I had the 3 assets, and then around 3 or 4 months later, I ended up buying something else in the city. And this is where I made my first mistake of property investing. Now, until this time, I had a winning strategy. I was 21 years old. I now had 3 investment properties. Things were going well. I had a winning strategy. I had equity, pulled out the equity, I'd made some smart moves. The rent was covering the mortgage, with positive cash flow. Things are looking good. So what changed? Well, first of all, emotion came on into it. I went from working as a property manager 3 days a week to moving into a financial planning role and doing a bit of BDM for them. So when I worked in the financial planning position, all of a sudden everybody was wearing suits. It was a corporate environment. I'm still living in the burbs, so I'm thinking I got to get closer in. I got to spend more time and nuzzle in with my fellow colleagues. So I started to become a bit emotional. I started to think, oh, those people have got Rolexes and cars on finance, which I didn't know at the time. And I wanted to keep up with those guys that I thought were really cool and they were doing a great job. So what did I do? Well, I wanted to show I was part of the crew. A lot of these guys were renting properties in the city and spending almost all of the money that they made. So what did I do? I bought my 4th property. Now my 4th property was not the same as my first 3. It was an emotional purchase. It was a hybrid purchase. So what that is it was thinking about investing, but investing wasn't the main thing. It was thinking about lifestyle. And my big mistake was combining the 2 of those things. So what I did is I bought the cheapest, shittiest sort of property that had, let's say, good characteristics. So it was technically a 2-bedroom, although the 2nd bedroom had big pillars in it and it was virtually unusable. It was a 2-bedroom, no car spot, and a really tight kitchen space. And what I paid for that was $345,000. So nearly double what I was paying for my other assets. And what was I getting here? Well, I was getting land content, none. I was cash flow. It was there, but it was low. Why was it low? Body corp. Something I didn't think about. The other thing, opportunity cost. Banks did not like this postcode. There was an oversupply of apartments. They were too exposed in the area for whatever reason, which means that they maybe put a 20% deposit down, and they also valued the property in a really poor way. So the property came in around $35,000 under value. So what did that do? Well, that chewed up all the good decisions that I'd made previously. It took all the equity that I'd made and it screwed up my opportunity cost of buying, because what I could have done is I could have taken my 20% and went, again, using my winning strategy, could have bought another 2 or 3 well-priced assets, could have kept going off to the races. Now, if I fast forward this situation here, I ended up selling this property around 6 or 7 years later at $315,000. So I made a loss on this property after all that period of time. So I had to offload that asset. Reason being, and not only was that loss of $30,000 realized, we also had stamp duty, which was around $15,000. We had other costs that was above and beyond what I'd lost, you know, your interest, your body corporate, all of that sort of stuff. I had a low income at the time, so I wasn't getting much of that back in my tax anyway. So negative gearing was not a strategy you should be doing at $70,000 of income. That's not a strategy. That's not a winning strategy. So that was a big L. And most importantly, I would say it costed me opportunity. I was not able to get into other assets. So I'd made some smart decisions. Now I tried to keep up with the Joneses. I bought an asset. There was no land content. The cash flow was low. There was a borrowing capacity issue. The banks told us right there it didn't like it, chewed up all the equity, and there was a massive opportunity cost. So a big lesson here was you should never buy an investment with a lifestyle mindset. Never think I could live here. Because the other thing is what you're gonna want in 2 or 3 years is gonna change completely. You're gonna have a family, you're gonna get new jobs. Life is uncertain. So putting a lifestyle certainty into a property is often a massive losing strategy. So 3 major lessons that I learned here was, first of all, buying on emotion and combining a investment approach to a owner-occupied approach was definitely a losing strategy. It meant that I didn't get either. The next thing was not focusing on the numbers and not being very diligent. I was overconfident. I'd had some good wins on the first 3 purchases that I made, and I was not doing the same things that actually gave me a winning strategy at the start. So the first property that I bought, I wrote 15 clauses in. I was extremely diligent. I was on realestate.com a bunch. This property I actually bought in my lunch break. I literally had an hour lunch break. I was working in the city. I rushed to the appointment. I signed the contract. I didn't negotiate. I didn't look at things. I was earning decent money of what I thought. I actually bought this property. One thing I didn't mention, I actually didn't tick subject to finance on this asset. I was wondering why the agent kept following me up to pay deposits. I was so confused. I realized later that I didn't put subject to finance. So I was fully locked in. And what also happened was my overconfidence meant that I didn't read the contract. I didn't put the subject to finance clause in. The agent didn't remind me of that. And yeah, he kept calling me, asking me to pay more and more money, and I was so confused. Then I later realized that I didn't read the contract. I didn't have a conveyancer review my contract first, and I didn't do the diligent steps, and that cost me greatly. So the first finance that I went through actually got declined, and then I had to go to a few different lenders, and I ended up getting a second tier lender, I believe, helping me get the finance over the line, but not without chewing up all of my equity, getting a poor valuation. So that was definitely a big L. So not looking at the numbers cost me greatly. And probably the highest cost was the opportunity cost. I was only earning around $70,000 income. I was working for a company at the time, and I wasn't able to keep buying. Banks no longer liked me. They loved me at the start when I had my positive cash flow properties, and they were growing at a great rate, and I used my savings and a little bit of equity to keep duplicating. But as soon as I bought this sloppy asset, all of a sudden none of the bankers wanted to call me back. Now this was a big part of why I wanted to start Maple. Now when I started Maple, a lot of people at the time were asking me, how did I have 4 properties at 21 years old? And The Age did an article about me because at the time I don't think there was anybody who'd managed to acquire that much by that short amount of time, and also I didn't get any help from family members or anything. So it was quite strange, and I was getting a lot of people starting to message me. I started to make basic content talking about my journey. I was sharing a bit of my journey, very early days on Instagram. So I get a lot of people that were reaching out. So I thought, all right, well, I was sort of helping a lot of them for free and giving them advice. And I thought, well, I've done an okay job here. Let's start helping people. And before I started Maple, I remember I would follow a lot of these companies and individuals who had really big portfolios, like bigger portfolios than me, much bigger. Like they had 70, 80 properties, 30 properties, guys that were in the industry a couple years older or a decade older for that matter. And I was sending them to some of those companies, and people were coming back and saying, oh, but we want to deal with you. We want to deal with you. So anyway, once I started Maple, it was for 3 main things: to avoid the mistakes that I'd made, and then to stay focused on the numbers, the data, and the statistics. So Maple was always, it was something that was to be data focused. The other thing that we did is managing safety and risk, which was something that was really quite big to me. So safety and risk management. A lot of people were scared at the time. I know a lot of the early clients wanted to buy in their own suburbs. I grew up in the northern suburbs of Victoria, so I remember a lot of my clients came from that area and they wanted to buy in Doreen, Eltham, Greensborough, all areas that they knew. However, helping them become more data focused meant that they could get a better result. And that meant that they could duplicate, and from that point, we could get the repeat business and keep purchasing. So I knew that that was going to be a winning strategy. And the other thing for me, I recall buying my first asset, it was so difficult for me to get that $15,000 together. Like if I was to figure out how long it would take me to earn that, $15,000 would take me 12 months of working 4 or 5 nights a week. So another thing that I wanted to do is have really good fee structures. And that structure meant that I wouldn't have to take clients' hard-earned deposits. So I didn't want my company to be like a buyer's agent. And it was before the big buyer's agent boom. I started the company in 2018. I didn't charge a fee for service. So what that meant is that clients' deposits weren't getting chewed away. Instead, I had a real estate license, and I also operated a bit of mortgage broking as well. With my real estate license, I was able to split with real estate agents. A typical real estate agent in Australia might get anywhere from 1.75% to 2 to 3% depending on the asset. So was able to sort of split commissions with them, look for deals that were not online and find motivated sellers. And with those motivated sellers, I was able to get the client a good deal and then also claim a fee from their side. So I didn't have to take money off the purchaser. And 90% of the investors that worked in Maple during that period of time were all under 30 years old. So they were all first-time investors. They all had worked hard to get their deposits together. We didn't do much guarantor loans or anything like that. So having a low fee for service was something that was really quite important to me. Didn't want to chew them away. The other thing is we operated in mortgage broking space, which means that we're paid the same way that a mortgage broker was paid. So for instance, $1 million worth of lending is roughly around $7,000 up front. And there's a bit of a reoccurring income that comes in as well. This isn't something that makes you pay a higher interest rate, but it's something where the bank pays us to essentially bring them a client. They haven't had to spend the marketing on it. So we made money that way as well, and that was a winning formula. We were able to go from around 2 to 3 staff all the way up to around 20 staff in the form of 18 months. And the main thing here is we would never recommend anything that we wouldn't buy ourselves. And what that means is at the start, we had a lot of clients that were buying in the same areas that I myself was purchasing in, as well as some of the guys that were working with us. They were all neighbors and buying in the same estates and so forth because, we had the conviction in the areas genuinely. I would always ask people that if you're getting advice off somebody that's helping you transact, do they actually have properties in the area that they're recommending you to actually purchase in? Because you want to see that the proof's in the pudding there. And that's something that was a big thing to us. So as a summary here, it's important to remember that you should buy what makes sense and always focus on the data. The other thing that's really important is making sure that you're not purchasing on emotion. And the other thing that's also extremely important is beginning with the end in mind. So end in mind and making sure that you have a plan as to why you're buying this asset and what is your exit plan here. Now, every investment portfolio always starts with one decision. For me, it was my $135,000 property, which then later was the foundation for me to duplicate and move into a greater portfolio. Now, your situation might be completely different suburbs, price point. Obviously, the market's come a long way since I purchased around 11 years ago. However, the fundamentals still remain the same, and the value for money, assets, and the data that's required in the property purchasing is all still relevant now as it was back then. For those of you that are wanting to learn a little bit more about the market, I would encourage you to book a free strategy call. It's all about just understanding your goals, what you want to achieve, and the strategy that's best going to align for you. If you found this video helpful, please click the like and subscribe button, as I'll be sharing a lot more information as to the mistakes I've made, how I built the portfolio, and I'm sure this information will be highly valuable to those people that are wanting to do some big things. Thanks for watching. I'll see you in the next one.